Before we dive in, please remember that this video is for informational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation should not be considered legal or financial advice. Always consult with a qualified professional for your specific situation. You get that bill in the mail, your car insurance premium, and it went up. Again, for no reason. You didn't get a ticket, you didn't have an accident, your car is a year older, so what gives? You're not alone. Millions of Americans ask this same question every 6 months, feeling completely powerless as their rates creep higher and higher. Feels random, feels unfair. But I'm here to tell you it is anything but random. Your auto insurance rate is not a number pulled out of a hat. It's the result of a cold, hard, brutally complex calculation. An algorithm that knows more about you than you can possibly imagine. It's a secret recipe, a black box that takes dozens of data points about your life, feeds them into a supercomputer, and spits out a single number, your price. And for most people, how that black box works is a complete mystery. Well, today we're going to smash that box wide open. Over the next few minutes, you are going to get a masterclass in how your insurance rate is really calculated. We are pulling back the curtain on the entire industry. I'm not just going to tell you what they look at, I'm going to tell you why they look at it. You'll understand the psychology, the statistics, and the hidden correlations that can cost you or save you thousands of dollars a year. By the end of this, you will no longer be a victim of the system. You will understand the game, you will know the rules, and you will be equipped with the knowledge to get the best possible rate. So how do they do it? It all boils down to one word: risk. Every single factor they analyze is designed to answer one question. How likely are you to cost them money? To figure that out, they look at 3 core categories. First, they look at you, the driver. Second, they analyze your CAR. And third, they scrutinize your world, where you live and how you drive. We're going to break down all 3, starting right now with the most important and most personal category, you. When we think about how a driver affects insurance rates, our minds immediately go to the obvious stuff: your driving record. Did you get a speeding ticket? Did you cause an accident? Of course this matters. A driver with a recent at-fault accident and 2 speeding tickets is a much bigger risk than someone with a spotless record. This is the one factor everyone understands. A major violation like a DUI can send your rates into the stratosphere for years. But here's the truth. Your driving record is just the tip of the iceberg. It's what's lurking below the surface that truly defines the price you pay. Let's start with something you can't control: your age. Statistically, drivers under the age of 25 are, by a huge margin, the riskiest group on the road. They have less experience, they're more prone to distraction, and they're involved in a disproportionately high number of accidents, especially serious ones. So a 19-year-old male will pay one of the highest rates possible, not because the insurance company dislikes him, but because the data from millions of other 19-year-old males says he's a massive financial risk. On the flip side, rates typically start to drop significantly after age 25 and continue to improve, hitting a sweet spot between the ages of 40 and 60, when drivers are seen as having the perfect blend of experience and maturity. And yes, your gender plays a role too. Historically, young men have paid more than young women because statistically they get into more frequent and more severe accidents. They speed more, they get more DUIs, and they take more risks. Now this gap is narrowing in some states, and some states have even banned the use of gender in rate setting. But for most of the country, being a young male is a 1-2 punch of high-risk demographics. Now for a factor that might surprise you: your marital status. Why on earth would an insurance company care if you're married? Again, it all comes back to statistics. Decades of data show that married individuals file fewer claims, are involved in fewer accidents, and are generally more stable and risk-averse than their single counterparts. From the insurer's perspective, getting married is a sign of settling down. You might have a family in the car, you're probably not out late at night as often, and you have more to lose. It sounds old-fashioned, but the numbers don't lie. Being married can instantly label you as a lower risk and shave a nice percentage off your premium. Okay, let's get to the big one. The single most powerful, most controversial, and least understood factor in your auto insurance rate: your credit score. That's right. In almost every state, the 3 digits that determine your ability to get a loan also have a massive impact on what you pay for car insurance. This is so important that insurance companies have developed their own version of it, called an insurance score, which is heavily based on your credit history. Why? What does your ability to pay your credit card bill on time have to do with your ability to safely merge onto the highway? The insurance industry's answer is correlation. Actuarial studies spanning millions of people and decades of data have shown a direct, undeniable link between how a person manages their finances and how they manage their driving. People with high credit scores who pay bills on time, keep debt low, and don't have accounts and collections tend to file fewer and less expensive claims. The theory is that financial responsibility is a strong indicator of overall personal responsibility. Someone who is meticulous with their budget is also more likely to be meticulous with their vehicle maintenance. Someone who plans for their financial future is less likely to make impulsive, risky decisions behind the wheel. It's a behavioral pattern. So if you have a poor credit score, insurance companies see you as a higher risk for filing a claim, regardless of how clean your driving record is. This factor is so powerful that a driver with a perfect driving record but poor credit could easily pay double what a driver with an accident and excellent credit pays. It's a brutal reality of the system, and it's the number one reason people are often shocked by the quotes they receive. But it doesn't stop there. They also look at whether you own a home. Homeowners, on average, get lower rates than renters. The logic is similar to marital status. Homeownership is seen as a sign of stability and responsibility. Insurers believe homeowners are more financially established and less likely to engage in risky behavior that could jeopardize their assets. Plus, if you bundle your home and auto insurance with the same company, you often get a significant discount, further lowering your rate. Finally, and this might be the most unsettling for some, they can look at your level of education and even your occupation. Once again, it's a game of statistics. The data might show that people with advanced degrees like a PhD or a master's file fewer claims than those with only a high school diploma. An engineer might be considered a lower risk than a pizza delivery driver, simply because their job doesn't involve constant, high-pressure driving. A teacher might get a discount because their profession is associated with caution and responsibility. It's not a personal judgment. It's a cold calculation based on the claim history of millions of people who share your demographic profile. So, before they even look at the car you drive or the street you live on, the insurance company has already built a detailed psychological and behavioral profile of you. They've assessed your age, your marital status, your financial habits, your stability, and even your profession to predict your future actions. You might be the safest driver in the world, but if your profile fits a high-risk pattern, you will pay for the past mistakes of strangers you've never met. Understanding these factors is the first and most critical step to taking back control. But who you are is only half the story. The other half is what you drive. And as you're about to see, the car you choose could be secretly sabotaging your insurance bill in ways you never imagined. Let's play a little game. Imagine two brand new sedans, sitting side by side in a dealership lot. They're both the same price, around $25,000. They both have 4 doors, similar horsepower, and top-notch safety ratings. One is a Honda, the other is a Kia. You get insurance quotes for both. The Honda's quote comes back at $150 a month. The Kia's quote, $300 a month. Double. For basically the same car. What is going on? Is the insurance company just flipping a coin? No. They're looking at your car and asking it 3 very specific, very cold, and very calculated questions. And the answers to those questions determine whether your car is an asset or a massive liability on your insurance bill. The first question is the most expensive one. How much will it cost to fix you? Not just the sticker price of the car, but the real-world cost of putting it back together after a wreck. See, a fender bender in 2004 was a simple affair. A piece of plastic, some paint, a few $100. But a fender bender today? That same bumper on a brand new car isn't just a piece of plastic. It's a high-tech nerve center. It's packed with sensors for parking assist, radar for adaptive cruise control, cameras for lane keeping. A whole suite of technology that has to be painstakingly replaced and, more importantly, recalibrated. That simple $500 fender bender can now easily become a $5,000 repair bill. And the insurance company knows this. They have databases overflowing with billions of data points on the cost of every single part, for every single model, and the exact labor hours required to fix it. This is why luxury cars like a Mercedes or a BMW are so notoriously expensive to insure. It's not just that they cost more to buy. It's that their parts are often proprietary, the technology is more complex, and the specialized labor needed to fix them is far more expensive. The algorithm sees a Mercedes E-Class and it doesn't see a luxury sedan. It sees a future potential claim involving German-engineered headlights that cost $3,000 apiece. And then you have the new frontier electric vehicles. An EV might seem simple, fewer moving parts, right? But the single most expensive component, the battery pack, is often integrated into the very structure of the car. Insurers are finding that even a minor collision that damages that battery pack can result in the entire car being a total loss. Why? Because replacing a $20,000, $30,000, or $40,000 battery pack on a $50,000 car just doesn't make financial sense. So while you're enjoying silent acceleration, your insurer is sweating over the possibility of a small crunch turning into a massive total loss payout. The data on these new, expensive repairs is pouring in, and the algorithms are adjusting your premium upwards in real time. That brings us to the second question the insurance company asks your car. How likely are you to get stolen? You might be the most careful, security-conscious person in the world. You park in a locked garage, you never leave your keys in the car. It doesn't matter, because you're being judged by the collective behavior of every other owner of that same car. The perfect and frankly terrifying example of this is the recent saga with certain models of Kias and Hyundais. A design flaw made them incredibly easy to steal with nothing more than a USB cable. A social media trend exploded, and suddenly these specific cars were being stolen at rates hundreds of times higher than any other vehicle. Now, think like the insurance algorithm. It's not emotional, it just sees data. And the data it saw was a catastrophic vertical spike in theft claims for these specific models. So what did it do? It jacked up the rates. Sky high. Not just for the people whose cars got stolen, but for everyone who owned one. People with perfect driving records who lived in safe neighborhoods, saw their insurance double or triple overnight, or even found themselves completely uninsurable. They were being punished not for their own risk, but for a manufacturing flaw in the car they chose. Your car's reputation, fair or not, directly impacts your wallet. It's why you'll always see full-size pickup trucks, like the Ford F-150 and Chevy Silverado, at the top of the most stolen lists. The demand for their parts on the black market is insatiable, making them a prime target. The algorithm knows this, and your premium reflects that risk, whether you live in rural Montana or downtown Manhattan. Finally, we arrive at the third and most counterintuitive question. How likely are you to hurt someone else? This is where everything you think you know about safety gets turned on its head. You'd assume that the car with the highest safety rating, the one that protects its occupants the best, would be the cheapest to insure. And you'd only be half right. Insurance is a two-sided coin. One side is protecting you and your car. This is where those 5-star crash ratings, airbags, and automatic emergency braking systems help you. They reduce the chances of you getting seriously injured, which means a lower potential payout for the insurance company under your medical payments or personal injury protection coverage. That's great. But the other side of the coin, the much larger side, is liability. That's the coverage for the damage you do to other people and their property. And this is the paradox. A massive 7,000-pound SUV with a reinforced steel frame might be one of the safest vehicles on the road for the people inside it. But in a collision with a 3,000-pound Honda Civic, that SUV becomes an instrument of immense destruction. The laws of physics are unforgiving. The insurer knows that while you might walk away without a scratch, the occupants of the other car could suffer devastating injuries, and their car will be obliterated. That means a much higher potential for a massive liability claim, hundreds of thousands, even millions of dollars. So while your giant, safe vehicle is protecting you, it's also dramatically increasing the risk you pose to everyone else on the road. And that increased liability risk is priced directly into your premium. So how do they keep track of it all? The repair costs, the theft statistics, the safety ratings, the liability risk for every single make, model, and trim level going back decades? They don't guess. They use a secret code. It's a system run by a company called the Insurance Services Office, or ISO. They are the ultimate data crunchers of the insurance world. For nearly every car, they create what's called a vehicle series rating. Think of it like a credit score for your car. It's a series of numbers that condenses all of this complex data, every crash test, every theft report, every parts catalog, into a simple rating. Your insurance company plugs your car's vehicle identification number, the VIN, into their system. It pulls up this secret ISO rating, and that becomes a massive multiplier in the complex equation that spits out your final price. So when you're shopping for a car, you're not just comparing horsepower, fuel economy, and leather seats. You are, without even knowing it, choosing a secret code that will follow you for years. A code that tells your insurance company exactly how much of a risk you've just parked in your driveway. We've now pulled back the curtain on how you are rated and how your car is rated. But there's a third, invisible force that dictates your price, one that has nothing to do with you or your vehicle. It's a factor so powerful it can double your rate just by moving one street over. We're talking about the invisible lines drawn across our maps by insurance companies, your location, and the secrets behind your zip code are more shocking than you think. It's a concept insurance companies call your garaging address. It's not just where you get your mail, it's where your car sleeps at night. And in the world of insurance, your car's bedroom is more important than your own. Think of your zip code not as a mailing address, but as a statistical tribe you've been assigned to. Every single claim filed by anyone in that tribe, every fender bender, every stolen catalytic converter, every fraudulent whiplash claim, gets thrown into a giant digital pot. The actuaries then stir that pot, analyze the contents, and assign a risk score to your entire area. You aren't just you. You are a resident of zip code 10021, or 90210, or 60611. You inherit the driving sins of your neighbors. Let's paint a picture. Meet two drivers. Let's call them both Sarah. Both are 35 years old, both have a perfect driving record, and both drive the exact same 2022 Honda CR-V. The only difference? One Sarah lives in a quiet, rural town in central Kansas. The other Sarah lives in the heart of Brooklyn, New York. The Sarah in Kansas might pay around $900 a year for her policy. The Sarah in Brooklyn? She could easily be looking at a bill for $3,000 or more for the exact same car and the exact same driver. Why the $2,100 difference? Because Brooklyn Sarah's car is sleeping in a place with millions of other cars. A higher rate of accidents per square mile, more auto theft, and more vandalism. The insurance company isn't insuring her. They're insuring her, plus the statistical chaos of her environment. But it gets much, much deeper than just city versus country. Insurers slice and dice your location with the precision of a surgeon. They are looking at hyperlocal data. We're talking about crime rates not just for your city, but for your specific police precinct. They subscribe to services that provide block-by-block data on vehicle thefts and break-ins. If your neighborhood has seen a spike in stolen Hondas, even if yours is locked in a garage, your rate is going up. They see you as a target in a target-rich environment. Then they overlay that crime map with a weather map. Do you live in Oklahoma's Hale Alley, where golf ball-sized ice can destroy hundreds of cars in an afternoon? Your comprehensive coverage rate just went up. Do you park your car on the coast of Florida or Louisiana during hurricane season? Your rate will reflect the massive risk of storm surge and flood damage. They know which areas are prone to flooding, which areas get severe winters with salted roads that cause rust and accidents, and which areas have relentless sun that damages paint and interiors, leading to higher claims down the road. You're not just paying for your driving. You're paying for the wrath of Mother Nature in your specific corner of the world. But here's the factor most people have never ever heard of. It's one of the industry's biggest secrets, and it has nothing to do with crashes or crime. It's the local legal climate. In some counties and states, it is far more common for people to hire a lawyer and sue after an accident, even a minor one. These areas are known in the industry as litigious. Juries in these areas tend to award higher settlements for bodily injury claims. So if you live in a county where people are more likely to sue and win big, the insurance company jacks up your bodily injury liability premium to cover their potential legal costs. You could be the most careful driver in the world, but because your local court system is generous to plaintiffs, you pay a penalty. Two towns right next to each other but in different counties can have wildly different rates purely because of how their local courts operate. And it doesn't stop there. Think about the cost of repairs. A mechanic's hourly labor rate in Los Angeles is drastically different from one in Little Rock, Arkansas. The cost of parts, storage fees for a wrecked vehicle, rental car rates. It all varies by location. The insurer bakes the average local cost of fixing a car into your premium. So, part of your bill is determined by the price your local body shop charges to fix your neighbor's bumper after they backed into a pole. Now let's go back to that idea of moving one street over and doubling your rate. This is not an exaggeration. It happens all the time in major cities. Imagine a street that serves as the dividing line between two zip codes. On one side, you have a neighborhood of single-family homes with private garages and driveways. The claim frequency there is low. On the other side of that exact same street is a zip code filled with massive apartment complexes, where everyone parks on the street. The density is higher, there are more cars, and the rates of sideswipes, break-ins, and hit-and-runs are 10 times higher. If you live in an apartment on the wrong side of the street, your premium could be 40, 50, even 60% higher than your neighbors across the way. Even though you shop at the same grocery store and drive on the same roads. The insurance company has drawn an invisible, high-stakes line right down the middle of your street. So what can you do about this? You can't exactly fight City Hall, or in this case the actuarial map. But you can be strategic. If you're planning on moving, even just across town, you need to treat an insurance quote as a critical part of your decision-making process, just like checking out the local schools or crime statistics. Before you sign a lease or a mortgage, get quotes for that new address. Go to an online quote aggregator and plug in the zip codes of a few different neighborhoods you're considering. You might find that moving 2 miles east saves you $800 a year on your car insurance, which could completely change your budget. You might discover that the apartment with slightly higher rent is actually cheaper overall because it's in a preferred insurance zone. Don't wait until after you've moved to find out you've relocated to a high-risk territory. You are, in essence, interviewing a neighborhood to see how it will affect your financial life. This geographic profiling is the bedrock of insurance pricing. They are betting on the collective behavior of the people around you. They're betting on your weather, your local mechanics, and your county courthouse. You, the individual, are almost secondary to the data points of your location. It's a cold, hard calculation. And it means that even if you're a perfect driver living in the perfect, low-risk zip code, there's another giant variable that can completely sabotage your rate. A factor that has nothing to do with where you live, but everything to do with what you're driving. Because the car you choose to park in your driveway might already be on an internal insurance company blacklist, flagged as a high-risk money pit before you ever even turn the key. And the reasons why will absolutely shock you. It's not so much a formal list written down in a leather-bound book, but a digital dossier. A constantly updating, algorithm-driven risk profile for every single make and model of car on the road. When you ask for a quote, your chosen vehicle is instantly cross-referenced against this massive proprietary database. And it's judged on 3 secret metrics, 3 cardinal sins that can land it on an insurer's high-risk list. The first and most obvious sin is being a theft magnet. You might think this is all about high-end luxury cars, the kind you see stolen in movies. But you'd be wrong. In recent years, some of the most stolen vehicles in America have been ordinary, affordable Kias and Hyundais. A viral social media trend taught thieves how to start them with nothing more than a USB cable, because the manufacturers, in a cost-cutting move, didn't install engine immobilizers on millions of their base model cars. Suddenly, owning one of these vehicles became an open invitation for theft. Insurance companies aren't charities, they're risk assessors. They saw the claims skyrocket. They saw tens of thousands of these cars being stolen, joyridden, and crashed. So what did they do? They ran the numbers. The algorithm flagged these specific models as extreme risks. In some cities, rates for these cars tripled overnight. In other cases, major insurers like State Farm and Progressive simply refused to write new policies for them at all, effectively blacklisting them. It didn't matter if you were a perfect driver with a spotless record. It didn't matter if you lived in the safest gated community in the country. The simple fact that you owned that specific make and model meant you were now part of a high-risk group, and you were going to pay for the sins of the manufacturer and the actions of thieves 1,000 miles away. Your premium is subsidizing their risk. And it's not just about total theft. It's also about parts. The catalytic converter on a Toyota Prius, for instance, contains more precious metals than many other cars, making it a prime target for thieves who can saw it off in under 60 seconds. Insurers know this. They have data on how many Priuses get their converters stolen per capita in your zip code. So while you see a fuel-efficient, reliable hybrid, they see a car with a bullseye painted on its undercarriage, representing a guaranteed $2,000 claim just waiting to happen. The second cardinal sin your car can commit is having a glass jaw. It's all about the cost of repair. This is where the shiny, tech-filled cars of today become a massive liability. Let's say you have a minor fender bender in a 15-year-old Ford F-150. You might need a new bumper, maybe a headlight. You can find the parts easily, any body shop can do the work, and you're back on the road for a relatively modest sum. Now imagine that same fender bender in a brand new electric SUV. That bumper isn't just a piece of plastic. It's a sophisticated piece of technology embedded with sensors, cameras, and radar for the vehicle's advanced driver assistance systems. A tiny crack can throw the whole system out of whack. The repair isn't just a simple replacement. It's a multi-thousand-dollar job that requires specialized equipment and technicians to recalibrate the entire safety suite. The headlight isn't a $100 bulb. It's a $2,000 sealed LED matrix unit that has to be replaced entirely if it gets a crack. Insurance companies have access to staggering amounts of data on this. They work with networks of body shops and parts suppliers. They know down to the penny the average cost to repair every single component on your car. They know that the aluminum body panels on a new Ford F-150 are way more expensive and difficult to repair than the steel ones on the older models. They know that a cracked windshield on a Subaru with eyesight technology can cost over $1,000 to replace because the cameras have to be painstakingly recalibrated. You see a cool feature, they see a massive future expense. Your car's complexity, its technology, and the materials it's made from are all itemized on a spreadsheet that directly calculates your collision and comprehensive coverage rates. A car that's expensive to fix is a car that's expensive to insure. Period. But the third sin is the most insidious, the one most people never even consider. It's not about how well the car protects you. It's about how much damage it does to other people. This is called the injury liability rating. Your insurance company's biggest financial risk isn't fixing your car. It's paying for the hospital bills, lost wages, and pain and suffering of the people you might hit. And the type of car you drive is a huge predictor of that cost. Think about a massive heavy-duty pickup truck or a giant 3-row SUV. In crash tests, they often get 5-star safety ratings. They're built like tanks. If you're inside one during a crash, your chances of walking away are pretty good. But what happens to the person in the Honda Civic you hit? The laws of physics are unforgiving. The sheer weight and height of that larger vehicle create a devastating mismatch. The insurer knows this. They have decades of real-world accident data that shows certain vehicles, because of their size, weight, and design, are disproportionately likely to cause severe injuries and fatalities to the occupants of other cars in a collision. So while you bought your giant SUV to keep your family safe, your insurer sees it as an injury machine, a vehicle that dramatically increases their potential payout for a liability claim. And your liability premium, the part of your bill that covers damage you do to others, is priced accordingly. It's the same reason sports cars are so expensive to insure. And it's not just about speeding tickets. A low-slung high-performance car is more likely to be involved in a high-speed, single-vehicle accident resulting in serious injury to the driver and any passengers. The data proves it. The Lamborghini driver who wraps his car around a tree represents a much higher potential medical claim than the minivan driver who backs into a pole at the grocery store. One is a potential multi-million-dollar payout. The other is a few thousand for a new bumper. The algorithm knows the difference. So when you choose a car, you're not just picking a color or an engine size. You're inheriting its entire history, its entire risk profile. A car can be a triple threat. A theft magnet that's expensive to repair and more likely to cause serious injury in a crash. Think of something like a Dodge Charger Hellcat. It's one of the most stolen cars in America. Its high-performance parts are incredibly expensive to replace. And its 700-plus horsepower makes it a massive liability risk. To an insurer, it's the perfect storm. A car that's practically designed to generate claims. So even if you've picked the most boring, reliable, and safe sedan, a car with a clean record and low repair costs, you've only solved one part of the puzzle. You've addressed the what. But the insurance company is far more interested in the who. Because even with the perfect car, the rate you're ultimately given has less to do with the machine in your driveway and everything to do with the incredibly detailed, and sometimes shockingly personal digital file they've already built on you. And the most heavily weighted factor in that file, the one thing that can double your premium in an instant, has absolutely nothing to do with how you drive. It's your credit score. More specifically, it's a secret modified version of your credit score that they call an insurance score. And in 47 out of 50 states, this single number can have a more dramatic impact on your auto insurance premium than a DUI conviction. Let that sink in. A person with a perfect driving record but poor credit will often pay hundreds, sometimes thousands of dollars more per year than a convicted drunk driver with excellent credit. Your first reaction is probably the same as mine was. What on earth does my ability to manage a credit card have to do with my ability to safely merge onto a highway? Feels disconnected. Feels unfair. And consumer advocates have been screaming this from the rooftops for years. But the insurance industry has a very specific, data-driven answer. And to understand the entire system, you have to understand their logic. From their perspective, decades of data have shown a powerful statistical correlation. Not a causation, but a correlation. People with lower credit-based insurance scores are, as a group, more likely to file claims. Now notice the careful wording there. File claims. That doesn't just mean they cause more accidents. It means they're more likely to use their insurance for everything. A cracked windshield, a minor fender bender in a parking lot, a comprehensive claim for hail damage. The industry's theory is that a person who is financially stable is more likely to just pay for a small $500 repair out of pocket to avoid the hassle and the potential rate increase. Someone under financial pressure, however, has no choice but to file that claim. They need the car fixed and the money isn't in their bank account. So the insurer argues a low credit score isn't a measure of your character. It's a predictor of your likelihood to cost them money over the life of the policy. It's a risk metric. To them, a driver who files 2 small claims is a greater financial risk than a driver who causes 1 major accident but has a history of never filing claims for anything minor. It's a cold, hard actuarial calculation. But this is where the statistics crash into reality. The difference in premiums is staggering. A 2015 Consumer Reports study looked at 2 identical profiles for a single adult driver. Same car, same address, same clean driving record. The only difference was their credit level. The driver with good credit paid, on average, about $1,600 a year. The driver with poor credit? They were quoted an average of over $3,800 a year. That's a $2,200 penalty for having a low credit score. They were paying more than double, despite being, by all traditional measures, a perfectly safe driver. In some states, the penalty was even more severe. In Michigan at the time, the difference was over $5,000. In Florida and New York, it was over $3,000. This practice effectively creates a 2-tiered system. It penalizes the poor, the young person just starting out with a thin credit file, the person who lost their job and fell behind on bills, or the family bankrupted by medical debt. It's a cycle. Financial hardship leads to a lower credit score, which leads to exorbitant insurance premiums, which creates even more financial hardship. This is why a handful of states, California, Hawaii, and Massachusetts, have banned the use of credit information in setting auto insurance rates altogether. Michigan has also recently passed laws to severely limit its use. But for the vast majority of Americans, your credit history is a primary non-negotiable factor. So how do they even get this information? When you fill out that online form for a free no-obligation quote, you are giving them permission. Buried in the terms and conditions is consent for them to perform what's called a soft pull on your credit report. Unlike a hard pull, when you apply for a mortgage or a car loan, this soft inquiry doesn't affect your credit score, but it gives the insurer, or more accurately the data broker they work with, everything they need. They don't just get your FICO or Vantage score that you might see on a free credit monitoring app. They feed your entire credit report, your payment history, your level of debt, the length of your credit history, the types of credit you use, and any recent applications, into their own proprietary algorithm. This algorithm is a black box. It's a trade secret, but we know what it prioritizes. Any history of late payments or collections is a massive red flag. High credit card balances are a bad sign. A short credit history is seen as risky. The algorithm then spits out your special insurance score. This score is then used to place you into a tier. These tiers have different names at different companies: preferred, standard, non-standard, or just numbered levels, but they all function the same way. The preferred tier is for the lowest risk customers with the highest insurance scores, and they get the absolute best rates, the ones you see advertised on TV. Everyone else gets slotted into progressively more expensive tiers. The jump from one tier to the next isn't a smooth curve. It's a cliff. A small drop in your insurance score, maybe from one late payment you forgot about, could be enough to knock you down a tier at your next renewal, causing your premium to skyrocket by 30 or 40%, even if your driving record is still spotless. You'll call them confused, and they'll give you a vague answer about rising costs or updated risk assessments in your area. What they won't tell you is that their secret algorithm has quietly relabeled you as a bigger risk. And this credit data is just the foundation. It's the gateway to an even more invasive level of scrutiny, because the same data brokers that package your credit information, giants like LexisNexis and Verisk, don't stop there. They are information sponges, and their main clients are insurance companies. They are building a far more comprehensive file on you, pulling from sources you've never even heard of. The most important of these is a secret industry report that every driver has but very few know exists. It's called a CLUE report, which stands for Comprehensive Loss Underwriting Exchange. Run by LexisNexis, this database is essentially the permanent record for your insurance history. Every auto insurance claim you've been involved in for the past 7 years is on this report. That includes every accident, whether you were at fault or not. It includes every comprehensive claim for theft, vandalism, or weather damage. But here's the truly shocking part. It also includes claims where no money was ever paid out. Let's say someone backs into your car in a parking lot, and you call your insurance agent just to ask if you should file a claim. You discuss the damage, learn your deductible is $1,000, and the repair is only $800, so you decide to just drop it and pay yourself. In the eyes of the CLUE database, a claim inquiry was made. It gets recorded. It now looks to other insurers like you were involved in an incident, making you appear riskier, even though your insurance company never spent a dime. Your credit score was just the first door they walked through. What they find in these secret industry reports can blacklist you from affordable insurance for years. And it's all based on a history you might not even know they're keeping. This history is compiled into a data dossier, a shadow profile that follows you from one insurance company to the next. It's officially known as the CLUE report. That stands for Comprehensive Loss Underwriting Exchange. And it is, without a doubt, one of the most powerful and secretive tools the insurance industry has at its disposal. Think of it as the credit report for your insurance life. But instead of tracking loans and credit cards, it tracks every interaction, every claim, and even every question you've ever had with an auto insurer. Nearly every major insurance company in the United States, we're talking over 99% of them, feeds information into this massive, shared database. They all pour their customer data in, and in return they all get to see everyone else's data. When you apply for a new policy, the first thing that underwriter does, after pulling your credit-based insurance score, is pull your CLUE report. And what they find there can be devastating. Let's imagine a scenario. You're a great driver. No tickets, no accidents in years. One morning you come out to your car and see someone sideswiped you in the parking lot overnight. It's not terrible, just a long, ugly scratch and a small dent along the passenger door. You're annoyed. You know your deductible is $1,000. You get a quick estimate from a local body shop, and they quote you $1,200 for the repair. So you do what any responsible person would do. You call your insurance agent. You say, "Hey, someone hit my car. The repair is about $1,200, my deductible is $1,000. Is it even worth filing a claim for $200? How will this affect my rates?" Your agent is friendly. They tell you that, honestly, for $200 it's probably not worth it. A claim on your record could raise your premium by more than that over the next few years. You thank them for their honesty, hang up the phone, and decide to just pay for the repair out of pocket. You never filed a claim. You never received a single dollar from the insurance company. In your mind, the incident is over. You'd be wrong. Dead wrong. Because that phone call, that simple inquiry, just started a 7-year countdown. The moment you mentioned the word accident or damage to your agent, they were obligated by their company's rules to create an entry. It might not be a formal claim, but it's logged as an inquiry with no payout. And that log goes straight to the CLUE database. 6 months later, your policy is up for renewal. You get the bill and your jaw hits the floor. Your rate has jumped 20%. You call your insurer furious, demanding to know why. They're vague. They mention new risk calculations and updated models. They won't tell you the real reason. Frustrated, you decide to shop around. You're a perfect driver after all. Someone else will want your business. You apply to 3 other major carriers. The first one denies you outright. The second gives you a quote that's even higher than your renewal rate. The third offers you a policy, but it's with their high-risk subprime division, at a price that's frankly insulting. What is going on? You have a perfect driving record. You've never even cost an insurance company a penny, but you have a ghost haunting you. That inquiry with no payout is now a permanent part of your CLUE report. To every other underwriter in the country, that entry doesn't say responsible driver who asked a question. It screams potential claim. It looks like you had an incident, started the claims process, and then maybe abandoned it. They don't know the context. They just see a data point, and that data point paints you as a higher risk. They see you as someone who has incidents, someone who is involved in situations that could lead to claims. Their algorithm doesn't care that you paid out of pocket. It just sees a blotch on your record, a sign of instability. This is the brutal power of the CLUE report. It's a shared industry weapon that operates on the principle of guilty until proven innocent. An incident is an incident whether they paid for it or not. The system is managed by a massive data broker called LexisNexis Risk Solutions, a name you've probably never heard, but a company that has more data on you than you can possibly imagine. They are the gatekeepers of your insurance history, and it's not just them. A rival company, Verisk Analytics, runs a similar database called A+, which stands for Automobile Property Loss Underwriting Service. Between CLUE and A+, Your insurance history is an open book to the entire industry. Every fender bender you reported, every hail damage claim you filed, every time your car was stolen, and yes, every time you just called to ask a hypothetical question, it's all in there. And these entries have a long memory. Information on your CLUE report, including those damaging inquiries, stays there for 7 years. 7 years of being judged for an accident you weren't at fault for. 7 years of paying more for a claim you never even followed through on. It follows you from state to state, from insurer to insurer. You can't escape it. It's the reason why a driver with a single minor not-at-fault claim from 5 years ago might pay significantly more than a driver with a completely clean slate. The algorithm sees that past claim and flags you as statistically more likely to file another one in the future. It doesn't matter if the last one was a tree branch falling on your car during a storm. The data says you are a claim filer, and you will be priced accordingly. Now here's the one sliver of light in this dark room. Just like your credit report, you have a legal right under the Fair Credit Reporting Act to see your own CLUE report. You can request a free copy every 12 months from LexisNexis, and you absolutely should. You need to know what your insurer and every potential insurer is seeing. You need to check it for errors, for phantom claims, for inquiries you never made. Because if there's a mistake on that report, it could be costing you thousands of dollars over the years without you ever knowing why. This system of historical data, this 7-year rap sheet, has been the backbone of insurance pricing for decades. It allows them to punish you for the past. But the industry is changing. The technology is evolving at a terrifying pace. They're no longer satisfied with just looking back at the last 7 years of your life. That's ancient history. They want to know what you're doing right now, today, this very second. What if I told you that the most powerful factor in setting your future insurance rate isn't your credit score, or your zip code, or even your CLUE report? What if it's the exact time of day you drive to the grocery store? The specific route you take to work? How hard you brake when a light turns yellow? How quickly you accelerate onto the freeway? They used to have to guess at how you drive based on proxies and historical data. They don't have to guess anymore. They know, because millions of Americans are now voluntarily putting a spy in their own car. A spy that reports every single move, every hard brake, every late-night trip, directly back to the insurance company's servers, building a profile on you that is more detailed and invasive than anything that has ever existed before. Your past is one thing, but it's your present behavior that's about to become their most profitable weapon against you. This weapon has a friendly name. It's called telematics. You probably know it as a usage-based insurance program. Your insurer might call it Drive Safe, Snapshot, or DriveWise. They present it as a simple, fair bargain. Let us monitor your driving, and if you're a good driver, we'll give you a discount. A big one. Up to 30 or even 40% off your premium. Sounds like the future. Sounds like a revolution in fairness. Finally, a way to be judged on your actual driving, not on the dusty old statistics of people who happen to share your age or zip code. They make it incredibly easy to sign up. Just download an app on your smartphone, or they'll mail you a tiny device you plug into your car's OBD2 port, right under the steering wheel. Takes less than a minute. And just like that, you voluntarily placed an informant in your own vehicle. An informant that records everything. An informant that never sleeps. An informant whose only loyalty is to the company's bottom line. Let's break down what this little spy is actually watching. It starts with the basics. How many miles you drive. The more you're on the road, the higher your exposure, and the greater the statistical chance of an accident. Simple enough. But that's just the appetizer. The main course is how you drive. The device's accelerometer and your phone's GPS work in concert to track every single instance of hard braking. Every time you accelerate quickly, every time you take a corner a little too fast. It's also tracking the time of day. A drive at 2 in the afternoon is viewed completely differently than the exact same trip at 2 in the morning. Why? Because accident data, especially fatal and alcohol-related accidents, skyrockets after midnight. So if you're a night shift worker, a baker getting to work at 4 a.m., or just a night owl, you are immediately flagged as a higher risk, regardless of how perfectly you drive. And then there's the most damning piece of evidence they collect, the one made possible by using your smartphone as the tracking device. Phone usage. The app can detect when the phone is being handled, when you're texting, when you're talking, and when you're interacting with the screen, all while the vehicle is in motion. This is the smoking gun. Distracted driving is one of the leading causes of accidents, and they now have a second-by-second log of every time you do it. So every trip you take becomes a test. Every drive is an audition. That hard brake? That's a demerit. It doesn't matter that you slammed on the brakes to avoid a deer, or a child who chased a ball into the street. The algorithm has no context. It cannot see the world outside your car. It just sees a data point. Hard braking event. A sign of aggressive driving, of following too closely, of not paying attention. That rapid acceleration? You might have been merging onto a 70-mile-per-hour highway, needing to get up to speed to avoid causing an accident. The algorithm doesn't care. It flags it as aggressive acceleration. Another strike against you. The system is designed to judge the action, completely divorced from the reason. It's a digital prosecutor that assumes guilt. And you, the driver, have no opportunity to present a defense. The data is collected, fed into the machine, and a score is spit out. Your driving DNA reduced to a single cold number. This creates a bizarre and dangerous psychological effect. People with these trackers start driving for the algorithm, not for the road. You approach a yellow light. The safe, correct action might be to brake smoothly and stop. But you're worried about a hard braking event dinging your score. So maybe you speed up to try and make it through. You're on a winding road. The safe way to drive is to smoothly navigate the turns. But the app might flag your cornering as too fast. So you slow down to an unnatural crawl, potentially frustrating drivers behind you and creating a new kind of hazard. The very tool meant to measure safe driving begins to warp your behavior, forcing you to make choices that please a piece of software rather than react to the real, unpredictable world around you. But the danger goes far beyond just getting a bad score. This data doesn't just sit on a server to calculate your discount. It becomes a permanent part of your file. Now, imagine you get into an accident. It's a he said, she said situation. The other driver claims you were speeding. You know you weren't, but your insurance company pulls your telematics data, and it shows that 5 minutes before the crash, you were going 7 miles over the speed limit. Or that you had a rapid acceleration event when you pulled away from a stop sign a mile back. Suddenly, that data is no longer about a discount. It's evidence. Evidence that can be used by your own insurance company to assign you a higher percentage of fault, reducing their payout or even denying your claim. Evidence that can be subpoenaed in a lawsuit and used against you in a court of law. You voluntarily handed the prosecution the exact data they need to build a case against you. And here is the ultimate betrayal of the entire system. The promise is drive safe, save money. But for a huge number of drivers, that's not what happens. The initial discount you get for signing up is often just a temporary enrollment bonus. It's the bait. The switch comes 3 or 6 months later, when they've collected enough data to build your real profile. And many drivers are shocked to discover their rates don't go down. They go up. Sometimes they go up astronomically. That one late-night drive home from a friend's house? That time you had to slam on the brakes on the freeway? That moment you picked up your phone to change the map directions? It all adds up. The algorithm, with no understanding of context, brands you a high-risk driver. The very program you joined to save money becomes the justification for charging you far more than you were paying before. You are trapped. If you unenroll, you lose the initial discount and your rate might go up anyway. If you stay, the surveillance continues and any mistake can and will be used against you. The promise of fairness was an illusion. The reality is that you've paid for a potential discount with an invaluable currency: your privacy and your right to be judged with context. You've allowed a multi-billion-dollar corporation to install a black box in your life, one that watches, judges, and documents your every move on the road. They have turned your own car into a confession booth on wheels. So they have your past, meticulously scraped from public records and data brokers. They now have your present, a live streaming feed of your real-time behavior behind the wheel. They are building a profile of you that is terrifyingly accurate in its data, yet dangerously flawed in its conclusions. But there is one more layer to this. The final, most controversial piece of the puzzle isn't about how you drive at all. It's not about your past mistakes or your present habits. It's about who you are. The next factor we're going to expose is one they swear isn't discriminatory, but the data tells a very, very different story. Your credit score. Or more accurately, something they call a credit-based insurance score. It's a secret proprietary number, different from the FICO score you see, but derived from the same credit report. And in every state except for California, Hawaii, Massachusetts, and Michigan, it can have a more profound impact on your premium than a DUI conviction. Let that sink in. A person with a perfect driving record but poor credit can, and often does, pay hundreds, sometimes thousands of dollars more per year than a driver with an at-fault accident or a speeding ticket, but excellent credit. The insurance industry's defense is a masterclass in statistical sleight of hand. They'll tell you with a straight face that extensive studies show a powerful correlation between how a person manages their finances and how likely they are to file a claim. The argument goes like this. Someone who is financially responsible is also more likely to be responsible in other areas of their life. They're more likely to maintain their vehicle, to drive cautiously, to avoid risky situations. It's not about your wealth, they say, it's about your patterns of behavior. But let's peel back that corporate speak and look at the raw, brutal reality. What causes a low credit score? Is it always a pattern of irresponsible behavior? What about a sudden catastrophic medical emergency that leaves you with 6 figures of debt? What about losing your job during a recession and having to carry your family on credit cards for 6 months? What about a messy divorce that wrecks your finances? None of these events make you a worse driver. They don't suddenly make you forget how to merge onto a highway or check your blind spot. But in the cold, calculating eyes of an insurance algorithm, that medical debt, that layoff, that divorce, it makes you a massive liability. You are now a higher risk. Not because you drive any differently, but because your life took an unexpected, devastating turn. Consumer Reports have studied this for years, and the numbers are staggering. In some states, the penalty for having poor credit is over 150%. That means you're paying more than double what your neighbor with the same car and same driving record pays, simply because they have a higher credit score. It creates a vicious cycle. You're hit with a financial hardship, your credit drops, so your essential bills like car insurance skyrocket. This makes it even harder to recover financially, keeping your credit score low, which in turn keeps your insurance rates punishingly high. It's a debt trap, greased by the insurance industry, that has absolutely nothing to do with your safety on the road. But this personal financial audit doesn't stop with your credit score. They're building a complete avatar of you piece by piece to predict your future behavior. The next piece of the puzzle? Your marital status. Statistically, married people file fewer claims than single people. The industry's logic? Marriage implies stability, maturity, and responsibility. A married person is more likely to be home at night than out at a bar. They might have kids in the car, making them a more cautious driver. So if you're married, you get a discount. But let's flip that. If you're single, divorced, or widowed, you pay a penalty. You are, by default, considered a higher risk. Your relationship status, something deeply personal, is being used to charge you more for a service you are legally required to have. Next, they look at your housing situation. Are you a homeowner or a renter? Again, the algorithm slices reality into a simple binary. Homeowners are seen as more stable, more financially secure, and more rooted in their community. They are, in the eyes of the insurer, a better bet. Renters, on the other hand, are statistically more transient, often younger, and may have lower incomes. Therefore, they are a higher risk. So if you rent an apartment instead of owning a house, even if your apartment is in a safer, more affluent area than someone else's house, you will likely pay more. You are being judged not on your driving, but on your name being on a deed versus a lease. It gets even more granular and frankly more disturbing. They look at your level of education and your occupation. Yes, your job title can change your car insurance rate. Insurers have mountains of data that correlate professions with risk. An engineer, a scientist, or a pilot might receive a lower rate because those professions are associated with precision, rule following, and risk aversion. On the other hand, a job that involves late hours, high stress, or more time on the road, like a delivery driver or a journalist, might see higher premiums. They even look at your educational attainment. Someone with a PhD is often quoted a lower rate than someone with a high school diploma. The system is making a deeply class-based assumption that your socioeconomic status and your profession are reliable proxies for your behavior behind the wheel. And all of this culminates in the single most controversial and geographically arbitrary factor of them all: your zip code. We're not just talking about the difference between living in a dense city versus a sleepy rural town. We're talking about moving 2 blocks from zip code 90210 to 90211 and watching your premium jump by 40%. Why? Because the algorithm doesn't see you, sees your neighborhood. It analyzes the frequency of accidents, the rates of theft and vandalism, the cost of vehicle repairs, and even the litigation rates in your specific geographic area. You could be the safest driver in the world with a car locked in a secure garage every night. But if you live in a zip code with a higher than average claim frequency, you will pay for the mistakes of your neighbors. You are subsidizing their risk. This practice has been heavily criticized as a modern form of redlining. Historically, Redlining was a discriminatory practice where banks would refuse to offer mortgages in certain neighborhoods, typically those with high concentrations of minority residents. Today, insurance zip code rating can have a similar effect. It often results in residents of lower income, urban, and minority communities paying significantly more for car insurance than residents of wealthier, whiter, suburban communities, even when all other risk factors are identical. The industry claims it's purely based on localized risk data, but the outcome is a system that disproportionately penalizes people based on where they can afford to live. So let's put it all together. The insurance company has now built a profile of you without ever seeing you drive. They know your credit history, your marital status, whether you own or rent your home, your level of education, your job, and exactly where you park your car at night. They have created a financial and demographic clone of you, and they've assigned it a risk score. They've decided how much you'll pay based on a statistical ghost. It's a system designed to judge you on who you are, not how you drive. But there's one final frontier. One last piece of data that changes the entire game. All of this has been based on predicting your behavior. But what happens when they don't have to predict it anymore? What happens when they can watch it in real time? That little plug-in device or smartphone app they offer you for a discount? That's called telematics. And it's not a discount program. It's the final wall in their pricing prison, and it's far more invasive than you could ever imagine. They call it usage-based insurance. The pitch is seductive, isn't it? You're a good driver, so you should pay less. Just prove it to us. It taps into our sense of fairness, our belief that we're better than the average person behind the wheel. They offer you a small device to plug into your car's OBD2 port, or a simple app to download on your phone. They promise that if you just drive safely, you'll be rewarded with a hefty discount, maybe 20, 30, even 40% off your premium. Feels like a win-win. You save money, and they get to reward their best customers. But this entire premise is built on a carefully constructed lie. The truth is, telematics is not a discount program. It's a data harvesting operation on a scale we've never seen before. It is the single most powerful tool the insurance industry has ever developed to justify charging you more, and it operates under the guise of saving you money. That little device isn't a friendly scorekeeper. It's a spy, and it's reporting on your every move. Let's break down what it's actually watching. It's not just about whether you get into an accident. It's about a handful of key behaviors judged not by a human but by a cold, inflexible algorithm. First, hard braking. In the real world, a hard brake is often the sign of a good driver. It means you were paying attention. It means you saw the child run into the street. You saw the car in front of you slam on its brakes. You saw the deer leap out of the woods, and you reacted appropriately to avoid a collision. You prevented an accident. But the algorithm doesn't see that. It doesn't understand context. It only sees a rapid deceleration event. It logs the G-force, flags it as aggressive driving, and a point is scored against you. You saved a life, but your insurance score just went down. Second, rapid acceleration. Again, context is everything. Merging onto a busy highway often requires you to accelerate quickly to match the flow of traffic. It's the safe and responsible thing to do. Failing to do so could cause a massive pileup. But the app on your phone or the dongle under your dash doesn't know you're on an on-ramp. It just registers a lead foot, flags it as risky behavior, and docks you another point. You're penalized for following the fundamental rules of defensive driving. Third, the time of day you drive. This is where it gets particularly insidious. The data shows that driving late at night is statistically riskier. There are more drunk drivers, visibility is lower, and wildlife is more active. So, the telematics system penalizes you for it. Do you work a night shift? Are you a doctor, a nurse, a factory worker, a first responder? Too bad. Your rate is going up. Did you have a family emergency and need to drive to the hospital at 2 a.m.? The algorithm doesn't care about your sick child. It just sees a high-risk timestamp. You are being financially punished for the circumstances of your life and your job. Fourth, cornering. The device uses an accelerometer to measure the G-force as you take a turn. If you exceed a certain threshold, it's flagged as aggressive cornering. But who sets that threshold? Is it based on the posted speed limit for that corner? The weather conditions? The capabilities of your vehicle? No, it's an arbitrary limit set by the insurer. A sports car taking a turn safely is judged by the same rigid standard as a top-heavy SUV. You could be driving perfectly for your vehicle and the conditions, but if you trip that invisible wire, you're penalized. And then there's the most invasive metric of all, phone usage. This is the one they're getting incredibly sophisticated with. The app on your phone can use its own sensors to detect if the phone is being picked up, if the screen is being touched, if you're typing, if you're on a hands-free call versus holding the phone to your ear. It knows. They sell it as a safety feature, but it's a compliance test. And it's not foolproof. Are you a passenger using your phone? Is your phone in a cradle being used for navigation, which is perfectly legal? The system can often get it wrong, logging legitimate, safe usage as a dangerous distraction. Every tap, every swipe, becomes a potential mark against your name. Think about the psychological effect of this. You are no longer just driving your car. You are performing for an algorithm. You start to change your behavior not to be safer, but to please the machine. You might hesitate to brake hard when you should, for fear of getting a bad score. You might merge too slowly onto the freeway. You become so focused on the little score in the app that you stop focusing on the complex, dynamic environment of the road around you. They have gamified your driving, turning safety into a quest for a high score. And in the process, they may be making you a less intuitive, less decisive driver. And here is the part they never put in the commercials. This discount program can, and often does, result in a surcharge. They bury it in the fine print of the terms and conditions you scroll past. If, at the end of the monitoring period, the algorithm decides you are a high-risk driver based on its flawed and context-less data, your premium will not stay the same. It will go up. The very tool you adopted to save money is now being used as the primary justification to charge you significantly more. You voluntarily installed the surveillance that led to your own rate hike. Furthermore, what happens to all this data? This incredibly detailed log of your movements, your habits, your location, your speed, every single trip you take. You've given the insurance company a minute-by-minute record of your life. They own it. Can they sell it to data brokers? Can they use it to deny a claim? Imagine you get into an accident. They can pull up your entire driving history and argue that because you have a pattern of hard braking, you are partially at fault. Your own data becomes a weapon to be used against you. It can be subpoenaed in legal cases. It can be breached in a data hack. You have traded your privacy for the possibility of a discount, and in many cases you end up with neither. This isn't an insurance product. It's a Faustian bargain. They have built a system that preys on our desire to be seen as good and responsible, and they've twisted it into a 24/7 surveillance network that profits from penalizing normal, everyday driving. The friendly app with its cheerful graphics and encouraging messages is just the velvet glove on an iron fist. It's the final piece of the puzzle, allowing them to move beyond broad demographic categories and judge you on an individual, hyper-personal, and relentless basis. They sold you a discount, but they delivered a digital leash. Every turn, every stop, every late-night drive is logged, scored, and used to build the case against you. But this data collection is just the beginning of the story. It's the fuel for something far more powerful and opaque that's now running the entire industry. In the final part, we'll uncover the last, most secretive layer of the insurance pricing machine. The rise of artificial intelligence and predictive modeling, where they don't just judge what you've done, they predict what you will do. This is where the game changes entirely. For decades, insurance was a rearview mirror. It looked at your past, your accidents, your tickets, your age, to guess at your future. But today we're in the era of the crystal ball. Insurers are no longer just looking at what you've done, they are building complex algorithmic models to predict with terrifying accuracy what you are likely to do. This is the world of predictive analytics and artificial intelligence, the final invisible hand that sets your premium. At the heart of this revolution is a concept called telematics. You probably know it by its brand names: Progressive Snapshot, State Farm's Drive Safe and Save, or Allstate's DriveWise. These are the little devices you plug into your car's diagnostic port, or the apps you download on your phone. They're offered to you as a simple bargain. Let us watch you drive, and if you're a good driver, we'll give you a discount. It sounds straightforward, but what are they actually watching? Everything. They're tracking your mileage, of course, but more importantly, they're tracking your behavior. They measure how often you brake hard, a sign that you're following too closely or not paying attention. They log every instance of rapid acceleration, flagging you as an aggressive driver. They know the exact times of day you're on the road. A commute at 2 p.m. on a Tuesday is seen as far safer than a drive at 2 a.m. on a Saturday, a time statistically linked with impaired driving accidents. They're even monitoring your cornering speed. Take a turn too fast and the algorithm makes a note. Some of the most advanced apps can even detect phone usage while the car is in motion, the single most distracting thing a modern driver can do. All of this data, billions of data points from millions of drivers, is fed into a machine learning model. The AI sifts through the noise to find the correlations. It learns that people who consistently brake hard are 30% more likely to file a claim in the next year. It discovers that drivers who are active after midnight have a claim frequency that's double the average. The AI isn't just guessing. It's building a precise, personalized risk profile for you, based not on demographics, but on your actual second-by-second habits behind the wheel. This is the double-edged sword of usage-based insurance. If you're a genuinely safe, cautious driver who rarely drives during high-risk hours, you could see a significant discount. The system works for you. But if you live in a city that requires defensive, aggressive driving, lots of hard stops and quick accelerations just to survive rush hour, the algorithm might punish you. It can't tell the difference between a reckless driver and a driver reacting to a reckless environment. It only sees the data. Your reward for sharing your privacy could actually be a higher premium. But telematics is just the beginning. It's the data you knowingly give them. The truly secretive layer of predictive modeling involves data you have no idea they're even looking at. Insurance companies are increasingly partnering with third-party data brokers, the same massive, shadowy companies that collect your information for advertisers and credit bureaus. They are buying vast, comprehensive dossiers on your life, looking for clues about your personality and behavior that correlate with risk. What kind of data are we talking about? It's not just your credit score anymore. It's your purchasing history. The algorithm might see that you buy high-performance tires, subscribe to car modification magazines, and frequently purchase tickets to motor racing events. It could infer that you see driving as a thrill, a hobby, and flag you as a higher risk than someone whose purchase history is filled with baby supplies and home improvement goods. They can look at your social media activity, your online behavior, even your magazine subscriptions. It's about building a psychographic profile. Are you a risk taker in other areas of your life? Do you travel to exotic, adventurous locations? Do you participate in extreme sports? The insurer's algorithm might conclude that a risk-taker personality in life translates to being a risk-taker on the road. Let's imagine two identical profiles. Two 30-year-old men, living in the same zip code, driving the same Toyota Camry, with perfectly clean driving records. On paper, they should have the same rate. But data broker A tells the insurer that man number 1 recently bought a new set of all-season tires, subscribes to the Wall Street Journal, and his online activity shows he's been shopping for home security systems. Data broker B reports that man number 2 just bought a radar detector, has liked several street racing pages on social media, and recently searched for aftermarket engine tuners. Who do you think is going to pay more? And here's the most unsettling part. The insurance company never has to tell man number 2 that his online life is the reason his rates are higher. It's all hidden inside a proprietary algorithm, a black box that is protected as a trade secret. Often, not even the employees of the insurance company can explain exactly why the AI made a specific decision. They just know that, on average, the model works. This raises profound ethical questions. What happens when the data itself is biased? We know that certain zip codes have been historically over-policed, leading to more traffic citations for their residents. If an AI is trained on this biased data, it will learn to associate that zip code with higher risk, perpetuating a cycle of higher rates for an entire community. It becomes a form of digital redlining, where the algorithm, stripped of human context or compassion, simply amplifies the inequalities already present in society. The law is struggling to keep up. State insurance regulators, who are responsible for ensuring rates are fair and not discriminatory, are now faced with trying to audit complex algorithms they don't have the expertise to understand. How do you regulate a decision-making process that is designed to be opaque? So, after this entire journey from the car you drive to the AI that predicts your future, what does this all mean for you? It means that your auto insurance rate is one of the most complex and personalized prices you will ever pay. It is a story told in data points about who you are, where you live, what you've done, and what a machine thinks you will do next. But knowledge is power. Now that you understand the machine, you can make smarter decisions. You can now see why shopping around is so critical. Each company has its own secret algorithm, its own black box. One company's AI might heavily penalize you for your credit score, while another's might care more about your annual mileage. The only way to find out which algorithm favors your specific profile is to get quotes from everyone. You can focus on the factors you have the most control over. First and foremost, your driving record. Nothing will save you more money than being a safe, attentive driver. Second, your credit. It's not just for loans. It's a massive factor in your insurance. Improving your score can directly lower your premium. And third, be deliberate about the car you choose and the coverage you buy. Don't just accept the default. Understand what you're paying for. When you see an ad for a telematics program, you can now make an informed choice. Is the potential discount worth the constant surveillance? Is your driving style likely to be rewarded or punished by a dispassionate algorithm? The world of auto insurance is no longer simple. It's a high-stakes game of data, where every detail of your life can be used to calculate the price of your risk. You are not just a driver. You are a collection of thousands of data points, fed into a system that is constantly learning, judging, and predicting. By understanding how that system works, you are no longer just a passenger. You can take the wheel. Your insurance premium is the price you pay for the story your data tells. The real question is, what story are you letting it tell about you?